How would you say understanding of what physical risk means is like out there? Is there a gap in understanding? Are there any common misconceptions? And are there geographic variations? So do you see a better understanding in some locations than others? And could we perhaps learn as an industry?
Sure. So maybe I'll start with the last part of your question, which is the geographic variations in use and experience. And I will say, oddly enough, maybe because the US is not typically front runner when it comes to climate, we have seen a fast take-up rate of physical risk assessments in the US because this is where the risk is experienced firsthand in terms of the increase in extreme weather events, floods, hurricanes, wildfires that have had direct impacts on real estate and a number of other industries. In Europe, it's more of an emerging topic. But of course, Europe has had its share of windstorms and floods recently that are starting to shift mentalities towards, this also matters. And in APAC, there's a long-standing tradition of being exposed to a lot of extreme weather events, very strong building codes in markets where the real estate is maybe part of those global markets. So more nascent interest in understanding how those risks are going to shift. And so that's the second part of my answer is we've come a really long way and we have a really good understanding of current and future risks at this time. So starting with the climate component, right, using global climate models, we have a very good understanding of how the physical conditions in which we operate are going to change over the coming decades. And that includes, in particular, chronic changes around temperature, water stress, but also increased precipitation that can drive floods, increased in the drivers that cause hurricanes or wildfires. And the projections are quite narrow in terms of the range when you look 10, 20 years out, because there's a lot of impacts that are locked in. And then the projections range get really wide when you look further out. And this is where scenario analysis becomes really important, especially for risks like sea level rise. Now, we also have CAT models, catastrophe models that provide a very detailed probabilistic view of weather-related natural disasters, like hurricanes, floods, winter storms, wildfires. Current risk. What is the probability that this type of storm will hit this location tomorrow or next year? And those models were also growing to evolve the probabilities over time by integrating climate data so that we're able to say today's probability of hurricane is X, but over time it might grow to Y and Z because of the influence of climate change. And then we take these and we look at the impact on market trends. So we just recently released a report looking at the correlation and potential influence of flood and sea level rise exposure on construction trends in Florida. We look at the impact on credit risk for mortgages in particular. So looking at the impacts of recent extreme weather event on key markets in New York, Los Angeles, Houston. We looked at how metrics like rent, vacancy, NOI took a dip after a big flood or a big storm, how quickly they recovered or not. And then we take that and we build scenarios around what if or what when those events become more frequent, more intense, back to each other, how will that affect long-term market trends and, of course, credit worthiness of the mortgages. And then the work is really to integrate those metrics and sort of bring them to our customers into the various platforms so that we can help and support the integration of climate risk into decision making.
I can see there's a clear requirement. As an industry, we've got to take physical climate risk seriously. Do you think the awareness is there yet? Do you have any challenges in explaining your process to the market, to the industry?
This is where we've come a long way. There's when I founded for 27, and I was having those conversations in 2013, 2014, would get a lot of blank stares. I would get a lot of this is for 20 years down the road. Don't need to care about this right now. And then Mark Carney came in, and the TCFD and Paris alignment and the science, right? Unrelenting releases of reports showing how bad things are going to get if we don't act, and we're not acting fast enough. So at this time, it's been several years now that the phone is ringing, and that we have a strong understanding from maybe I would say the sort of the top tier of the market. I think there's still maybe some deeper tiers in the market, smaller groups that may not have that understanding or the resources to engage with those questions yet, but we're seeing that becoming more and more widespread.
Okay, thank you. So on to Eimear, from your experience as a debt and a lender, and you highlighted earlier that you've moved to issue a series of sustainability-linked and green loans. What do you see your biggest challenges are, specifically around awareness?
I think it's really around, we spend a lot of time sort of engaging with the borrower to explain to them about our green loan and how it works. And I think there's often a reticence, because I think borrowers like to know exactly their financing costs and like to have that fixed. And the way our green loan operates is that they make a commitment. So they commit to achieve a certain target. And so we spent a lot of time developing this. It's essentially a scoring system in our flagship partnership capital debt fund, where if a borrower achieves a certain score, then they qualify for a high ambition loan, and really that scoring and the high ambition is dependent around energy efficiency, so achieving a certain energy efficiency target, and then there's also a medium ambition, and it's engaging with them so that they understand, I guess, the process and how we look at it. I mean, we are heavily incentivized ourselves to issue these green loans. We've even got a line of credit linked to that fund, and the line of credit is linked to the amount of green loans that we issue. So we really see this as a big opportunity for us, and also for us as lenders, it's the way we can really influence. I mean, it's really the key leverage that we have. Yeah. And so we issue green loans and we provide a margin discount on the loan. And I think a lot of it has been around what is the right level of the margin discount in order to properly incentivize people and ensure that they can actually deliver on the commitments that they're making, and that it's achievable. And so because we invest in the private market as well, and it's in the mid-market, it's been finding that sort of level, because we're not investing in premium central London real estate where that's very well established building certifications. We're investing in sort of in the more regional areas of the UK and especially in Europe as well. And so it's finding that sort of the thresholds really. What are the thresholds that the market can tolerate? What makes sense for our borrowers as well? So it's been a lot of engagement with them, even in the development of our framework, to make sure that we've got it at the right level, and then following that to encourage them to actually commit.
So I guess from an early stage, you identified that if you created this in isolation and then took it to the market without the engagement with the borrowers, it wouldn't get very far.
Exactly.
So there has to be communication and understanding throughout that process. Peter, Bill, Nina, I'm keen to invite your views on general awareness. And do you see a challenge in the industry in terms of it's a big complex topic. We've talked about two key issues: green loans, physical climate risk just now. Do you see issues around awareness and around understanding, and what can we do to address this? Little question there. So Peter, would you like to go first, and then I'll open it up and.
I think there's no shortage of awareness in general. I mean, the topic is inescapable every day. It's in the papers, on TV, everywhere. Everyone is acutely aware. But I think what the flip side is of all that information, publicity in a way, is that some people are glazing over or are overwhelmed with the amount of information that's there to process. And when we look at the spectrum of our clients, we have some that are very sophisticated, but the majority is really starting on that journey, and is really trying to think very hard about how do we even start to systematically go through a very large portfolio that's spread out across the world. And what we're hearing is that they're finding it difficult to access the skills and the consultants, the infrastructure really to do this as quickly as many of them would like to. So it's a lot. The question is very much about the how.
Yeah. Okay. Bill.
I think I probably want to talk about two things.
Yeah.
One is investor behaviour, and the other is timeframes. So one, investor behaviour, and I would agree with the general comment that awareness is high. It's unequivocally the case for us that almost every single investor, or even groups of investors coming from from the retail side and private investors are putting this issue high on the agenda.
Yeah.
Now, I think it's there, but one thing that we're thinking hard about and have done for many years is making the connection between carbon transition and sustainability and the investment returns that we deliver. And this gets me to time frame. If you think about time frames, if you think about long term, okay, given the climate risk and the destruction of assets and the flooding and the weather and the behaviour of regulators, it's obviously the case that you have to put this issue very much into your thinking when you're thinking about risk and return. For a long-term investor, that's relatively easy. And by the way, if I'm thinking about now in 2021 versus where we were thinking about this in the 2007, the issue is looming larger and the timeframes feel shorter.
Mm-hmm. Yeah.
So I don't think it's difficult to really prioritise this now compared to 15 years ago. And I think the logic and the investor behaviour is absolutely taking us all in that direction, simply because you have to think about that to ensure that you're preserving the value of assets that you're investing in. And some people call it future-proofing. We've got lots to do, don't get me wrong, but I do think it's necessarily front and centre for investors. Investor behaviour is all over this, and as a fund manager, we have to treat that as being a first-order issue now, in the way that 15 years ago it was probably a little bit marginal or a bit optional, or we were a little bit wild and crazy then, probably, in the eyes of some.
Yeah. I think my practical experience is that the buy-in, the acceptance, the understanding, certainly at the investor level and the fund manager level, is there, and there's a recognition that we have to do something, and an acceptance, an absolute acceptance with the clients, the broad range of clients that we talk to, that there has to be progress. I think the challenge comes, and this is what we're hearing from COP as well, the challenge comes with action. And to make action, it's engagement of whole supply chains, of partners in a very complex topic. So I think, Nina, any views on that? And
I mean, kind of would definitely echo what's come before. And, I think our strongest push over the past 18 months has definitely come from investors, really asking very demanding questions, either due to their own commitments or where they see kind of regulation going. I think what we've struggled with is the upskilling, as you've mentioned, of the supply chain to deliver that. I mean, net zero building audits, for example. So everyone wants to understand net zero, but there's still a massive skills gap in the industry about what is a net zero building audit. And that's in the UK. When we start to think of portfolios in Asia, at the moment, it's almost impossible to access those types of audits in a lot of countries, probably not Australia, but, Japan, Korea. You've got language gaps as well. The tools that have been developed in Europe, let's say CREM, for example, that haven't really penetrated into kind of the market thinking, and it will happen, but not at the rate that our investors are kind of expecting us to respond to that. So I think there is a really significant skills gap, kind of people that have relied on very small sustainability teams. That is not going to be the model that scales. It has to be everyone's responsibility. And we are seeing really big upskilling within the supply chain, but at the moment I think there is a kind of misalignment in that. And I guess I've kind of made the point earlier, but I think one of the challenges is at the moment we're trying to upskill people about physical risk modelling and what that means. We're trying to upskill people about net zero and what that means. We're trying to upskill people about TCFD, SFDR, taxonomy. And I can see why people feel a bit overwhelmed at the moment, because it's quite complicated. It's not very interlinked. It's not simple. It's not easy to make decisions off basically quite individual topics. And I think very rapidly the industry could help itself if we tried to create a bit more simplification and standardisation in some of these, at least to get us to the next step. And probably won't be perfect, but I think it would be a bit of an improvement as to where we're at the moment.